We think that the UK can narrowly avoid a recession this year, with pound sterling continuing to weaken. Brian Davidson, Fathom Consulting. Well, the Bank of England appears set to cut interest rates this week for the first time since the financial crisis, as well as to lower its growth forecast by the biggest margin on record. Most would agree that action is inevitable, but to what scale are you expecting?
Well, I think, as you mentioned, it's widely expected that they'll cut the bank rate. We penciled in a 25 basis point cut, which has been fully priced in the markets. The question is whether they'll add additional stimulus in the form of QE, and this divides economists somewhat. We think they will, and we've penciled in a £50 billion increase in gilt purchases, as well as £10 billion in corporate bonds. In terms of their outlook, we think they will cut their growth forecast. There's no doubt about that. We think the UK can narrowly escape a recession this year, and that view is partly tied to the weakening of sterling. So we think sterling will continue to weaken, not just because of the actions that the bank are likely to take on Thursday, but because of the large current account deficit, which is over 5% of GDP.
Well, US non-farm payrolls gains data will be released at the end of the week, with the jobs data having averaged 172,000 so far this year. With a vast range in data in the previous 2 months, what are you forecasting for this Friday, and to what extent do you expect this to be significant?
We're forecasting 190,000 new jobs to be added in July, which admittedly is a slowdown from the rate of payroll growth last year, which was around 230,000. But something that's really important to point out is we've estimated that the break-even rate of payroll growth is around 60,000 jobs a month. So that is the level of payroll growth that's needed for the unemployment rate to stay the same. So in other words, anything above 60,000 new jobs a month, the labor market will continue to tighten. So it's on that basis that we think wage growth is likely to pick up this year, even if the rate of payroll growth slows a little bit. So while 190,000 slower than last year, in the bigger picture, it's actually likely to see the labor market continue to tighten. So this is one of the reasons we think that the Fed are likely to raise rates faster than the markets think at the moment.
Okay, and lastly for today, which other key indicators will you be looking out for this week that has the potential to shape the markets?
Well, obviously, the U.S. growth figure for Q2 was very disappointing on Friday. It came in below our expectations and below the market's expectations. A lot of that was due to inventories, which were particularly weak. So, we're still digesting that, but our view is that the U.S. economy is fundamentally still quite strong. And so this afternoon we'll have the ISM manufacturing survey. I think the markets will look at that pretty closely. And on Wednesday, there's the ISM non-manufacturing survey. So we expect this to show that the U.S. economy is still in good shape, particularly if the service sector is in good shape. That would go some way to reassuring the markets that global growth is not about to fall off a cliff. Other things that the market are likely to look at are the PMIs, the final readings for the June PMI for construction and services in the UK, as well as in the Eurozone. And people will be looking for more information on Japan's fiscal stimulus. The details are still pretty unclear. Estimates range between that it will be anywhere between 6 trillion yen and 28 trillion yen. So it remains to be seen to what end of the scale it turns out to be. So I think investors will be looking pretty closely for more details on that.
Thank you, Brian. Be sure to check back with the TV team to keep up to date with these market movers. I'm Sam Meredith, and we'll see you next time.